So this next panel is called On Aggregation Theory and Thin Protocols. I'm super excited to have two of my favorite intellectual sparring partners in crypto here with us today, Joey from Pantera and Jesse from Andreessen, A16Z Crypto. Eric, unfortunately, a flight kind of got moved around. But yeah, let's start things off. Joey, Jesse, please tell us background, how you got into this stuff.
Sure. How I got into crypto, the one-line version is I saw a post on overclock.net about earning free money with your GPU. Seemed like a scam, but 6 weeks later, it was still the #1 post on the forum. So I decided to check it out. My background is I started a project called Auger, which is a platform for prediction markets on Ethereum. And I'm currently co-CIO at Pantera Capital.
Cool. I got into crypto in 2013 when I saw a website, proofofexistence.com, which is probably one of the first non-financial use cases of the Bitcoin blockchain, and was very inspired that you could timestamp information about anything into this immutable ledger. Went on to start a project called MediaChain, which tried to track the provenance of digital media using the blockchain. That project ended up joining Spotify in 2017, just before the crypto markets really took off. And I went on about a year later to join Andreessen Horowitz, who had invested in MediaChain, and helped spin out A16Z Crypto, which is our dedicated crypto fund.
Awesome, guys. So to get started, I'm going to provide a quick 1-minute overview of aggregation theory, and then we'll kind of jump into the debate, basically, where will value accrue in the stack. So aggregation theory is kind of this idea that whoever owns the customer relationship has a lot of leverage in the supply chain and can ultimately impact what kind of feeds into customers. And so the great kind of modern case study is Netflix. A lot of people were concerned about Netflix in 2011, 2012, that they would never be able to accrue meaningful profit margins because if it's a public company, you can see the revenues, and the studios would always just keep charging more and more and more, and that Netflix would never be able to draw meaningful profits. And the kind of key insight that Netflix had was, well, we own the customers, and we can go make content ourselves, and we can just flip out the content. And because we own the customer relationship, right, we can actually derive meaningful profits. You can look at Google and Facebook in kind of the same way. There's a lot of elements of aggregation theory and how those guys who ultimately own the customer relationship can extract outsized profits in a value chain of market actors. And so that's kind of the general idea of aggregation theory. And so for the purpose of this panel, we're going to talk about some different protocols and projects in the space, as well as look at some traditional markets, financial markets, and kind of dissect this framework. So let's get started off with Coinbase versus Bitcoin. This was kind of like the fat protocols theory, as Joel described it. As you guys think about value capture and value accrual, like Coinbase versus Bitcoin, how do you guys think about that?
Yeah, so I think in the case of Coinbase versus Bitcoin, the argument goes that Coinbase is one of many companies. Its value, I don't know, today is probably in the billions, but Bitcoin's is 10 times that. And for every Coinbase, there's a long tail of companies that capture some of the value, but none of them capture as much as Bitcoin. And I think that's generally true, but I think it's especially true in this comparison because Bitcoin is competing for store of value. It's competing for global currency, and in order for Coinbase to work, the protocol itself needs to be conceived of as valuable as a store of value. So I think it holds in that case, but maybe not in all cases, and I think we'll get into that a little bit further on.
All right. Let's go to the one that's a little more kind of crypto native. Let's talk about 0x relayers versus the 0x protocol. Mm-hmm. We've got a lot of businesses on the built on 0x. You guys may be in some relayers or top of them. Joey, how do you think about kind of value capture here?
Yeah, so on the 0x side, I think if you think of 0x, when the project originally started, the vision was kind of you pool all of the liquidity for decentralized exchanges. And that's a great idea. Right now, though, there's kind of some technical challenges for actually doing that. You run into problems where orders collide and traders can't get their order filled. So the way everyone has solved that problem is by using these relayers, where they spin up a company or even just a project on top of 0x and have their own liquidity pool that isn't really shared. People can say, well, you can arbitrage between relayers, but even arbitrage has costs. Even on a blockchain where things are very efficient, there's always going to be some cost of arbitrage. And so if you look at 0x, I think one of the big challenges they're going to face is how do they figure out a way to pool liquidity? Because if they don't figure out how to do that, I think it is entirely possible that some relayer will kind of vertically integrate that market and just basically have people trading through them and not interacting with 0x at all. So from kind of a value capture perspective, if that problem's not solved, it's very hard for 0x itself to capture a lot of value.
So Joey, just to be clear, so what you're saying is, right, since a relayer owns the customer relationship, they could basically rip out the backend protocol and do anything they want, and the customer wouldn't know. That's kind of your concern for the 0x protocol.
Yeah, and if the liquidity were pooled, though, and they did that, it wouldn't work because they'd be removing themselves from this huge global liquidity pool. But since it's not pooled right now, yeah, that's a problem.
Yeah, and I would add to that, like the fact that liquidity is not pooled in the smart contracts means that 0x is really just sort of a library or blueprint for how to build a relayer. It's really just a message passing format. But because there's no liquidity at the smart contract layer, there's no way to think, or at least there's no way that we think of 0x as a network. It's really just an open source library. And so that lends itself well to forking and copying, and that's what a lot of relayers have done because they don't need to point to these canonical smart contracts on the blockchain because there's no liquidity there. There's no incentive for them to do that.
One conversation, Jesse, you and I have had is about the idea of like 0x is basically a schema where something like Maker or something like Auger, like there's a lot more state built on top of these applications, and so they become much harder to fork kind of as a result of this. I'm curious, are there any, as you look at kind of the general ecosystem, are there any other examples you can think of that like you guys find instructive as you think through things?
Yeah, so the debate is really, or the analysis is like, is this protocol a stateful network or is it a library, a schema, just a way of formatting things? And so yeah, Auger, Maker are two great examples where there's state in the smart contract, there's parameters in the smart contract that need to be set, and that incentivize liquidity to pool around that one contract. Another example is a project called Compound, which is a money market that's operated through a smart contract where the sort of interest rates are set algorithmically in the contract, and there's, again, liquidity collateral staked in this canonical smart contract. And so, where there's a sort of stateful smart contract, there are real network effects. There are network effects in liquidity, and in the case of Auger, in security, in trust that the oracles that are reporting the outcome of prediction markets are doing their job correctly. And as there's more liquidity on the supply side, there's more security for end users. So there's a sort of classic network effect, and that's just not the case in smart contracts that don't have that sort of statefulness.
Related to this, like one thing that's very clever in the Auger design, Joey, is the idea that rep holders or Auger token holders can generate income by doing some work for the network. In 0x, right, they don't have this concept, and so they've kind of come up with this governance idea. Can you explain to everyone like the theory behind why governance should be valuable in 0x, how it relates to liquidity pools?
Sure. So if you look at governance, I think the simplest way to explain why it would be valuable in something like 0x is if you think of regular exchanges in the world, like stock exchanges, bond exchanges, whatever it may be, they have seats on them. And if you have a seat, you generally have some sort of governance power. It's not really like one-to-one, and it's not really direct. It's kind of almost soft power. If you think of something like 0x, if you own stake in the network, you can literally decide how the exchange will operate, what sort of rules people are going to follow going forward. And that's also very hard to value how much that is worth, by the way. But it is an argument for why it could have value. So if you're a hedge fund and you're trading, think forward a decade, you're trading billions of dollars in volume through exchanges that use the 0x protocol. And it'd be great for you as a fund if you had the ability to modify that protocol to suit yourself. Now, in a competitive market, there's also going to be 1,000 other funds that also want to do that. And so people would, theoretically buy 0x so they can take part in the governance process.
Yeah, one debate we've had internally, and I'm not sure where you guys stand on this, but our sense is that, for any one party, the kind of, right, like the marginal voter in the US, right, like there's 100 million people who vote every presidential election. One vote doesn't move the needle. Our kind of concern has been the tragedy of the commons problem here, where even if you are a party that uses the protocol a lot, it's pretty hard to justify like a large percentage of your balance sheet tied up in this asset, and that is tied up, predicated on the idea that other people are also tying up their assets and not selling their 0x as well. So we've been pretty skeptical of the governance idea. I'm generally a believer that bridge liquidity pools are okay, and that if there's a divisive enough of a fight, you'll just see a fork, like in the case of Bitcoin Cash. And that people will bridge liquidity if they need to. Joey, it seems like you're more opinion that like we will trend towards one liquidity pool, or are you just thinking that's the 0x ideal that we may not get there?
That's definitely the ideal. We're never going to get there because people have different opinions about how trading should work. This is why we have different exchanges around the world. There's also regulatory reasons why there are different exchanges. I do think that in the blockchain world that we'll have much fewer trading venues than we have in the regular world, because you can have global liquidity pools. But there are always going to be more than one, because people will just continuously debate on what a good market should look like, what market microstructure should be. All those sorts of things are there's never going to be one, but I think you will have fewer than you have in the regular, say, equities world.
Is that just a function of like regulatory arbitrage, basically, instead of having exchanges in every region, just like we'll have one or two global?
Yep.
Yeah.
I'm curious, follow-up question there is what do you think will be the sort of incentive structure that results in this global liquidity? Because today it's sort of lacking from 0x protocol.
Yeah, so if you look at something like 0x, 0x is designed as kind of an optimization, because today blockchains don't scale. It's like the simplest, most naive thing you could think of is, well, you just do all trading on chain. And that doesn't scale at all today. And the kind of next level from that is like, well, you do order placement off chain and filling orders, order placement off chain, filling orders on chain, which is what 0x does. I think if you fast forward another 4 or 5 years, the way the things will go, actually, in my opinion, is each individual market will be like either a plasma sidechain or a spoke in the case of something like Cosmos, or a parachain in the case of something like Polkadot. So each individual market will trade on its own little subchain. And if you do that, you do have the ability to actually achieve really high throughput numbers. I think that these networks will scale, and there's no reason why you couldn't have a blockchain that does 50 to 100,000 transactions per second at some point in the future. And so I think for that reason, if you have these liquidity pools that take place on chain and they're non-rent seeking, so they don't try to charge you fees for no reason, then I think it kind of naturally tends towards a smaller number of liquidity pools, because liquidity begets liquidity. And so if you think about having separate liquidity pools, the question is, okay, well, what reason do you have to have a separate one? One reason is there may be like a KYC AML liquidity pool, where institutions trade through that because they're required to have KYC on their counterparties. But there's probably not going to be like 100 0x relayers, in my opinion, in the end state. Or at least if there are, there'll be like 5 that have a bunch of volume and the rest won't.
Yeah, I think there's power laws to liquidity. And then the question is, will the order book that contains that liquidity be open or closed? And in the case of 0x architecture today, the incentive is to keep it closed.
Right.
Because you're a traditional company, that's how traditional companies work. But in the case where you have a fully scalable blockchain and the order book is open, then all the liquidity will end up there, and anyone can just build on top of that.
One thing we've always talked about internally is like, if we can get to a true on-chain decentralized exchange, like you guys are talking about, like should the off-chain relayers, like who provides the front end, should they capture any value at all? And our opinion is that they shouldn't. I don't know if you guys disagree there at all.
So the question is whether 0x relayers can capture any value?
Specifically in a world where we have on-chain order books.
Right. Yeah, I mean,
now there's no lock-in, like you can't have any lock-in.
I think it's definitely very hard to capture any significant margin, but the things that are left to compete on are like user experience and then like ancillary services around that. But so like that trading can be a wedge. Trading is very like commodity business, but maybe there's a wedge to other sort of financial services, and that's where the margin's captured. And having a good sort of user experience is the differentiator.
Yeah, I think it would be hard to capture value because you're building on top of something that's completely open source. If your thing's not open source, then users have no confidence that you won't just steal all their money. The one area where I see people being able to capture value is if they create UIs on top that are meant for more like institutional players. So if you view crypto as like a parallel financial system, in the beginning it's mostly going to be like retail people who are participating in it, and then eventually institutions will come in. And on the institutional side, they're going to want to have certain assurances that you probably can't get from a decentralized peer-to-peer UI, but that you probably could get from a layer built on top.
All right, so like relatedly, like another interesting thing to talk about parallel financial systems is think about the New York Stock Exchange versus brokers, right? Today, for a given asset, the vast majority of the shares of that asset trade on one exchange. Sometimes we have kind of ADRs now that kind of work across exchanges and legacy system. Brokers, the Fidelities, the Schwabs, the Ameritrades of the world seem to have some value capture. As you guys think about like that legacy financial stack, as crypto kind of gets involved, maybe we move towards bearer assets, maybe we don't. What lessons can we draw from, NYSE broker structure as kind of crypto moves that direction? I don't know if there's any interesting parallels or contrasts that come to mind.
I think it kind of gets to what we were just talking about with this like open order book idea. Like if you have, if everything moves on chain, if there is an open order book that anyone can build on top of, you'll probably have a handful of trading venues that are successful and capture enough value to sustain themselves. And so there's probably not going to be thousands and thousands. There'll be like power laws to like 5 of them on top, and those will be the brokers. They'll be the the interfaces through which we access this pooled liquidity. So I think it kind of maps in that respect.
I would say one lesson to learn from is if you look at Robinhood as a company, I think their model is going to be very relevant here because.
Can you explain the Robinhood business model?
Yeah, so the Robinhood business model is it's a brokerage where you can trade for free, free in air quotes. And the price that you pay is where they basically sell your order flow to HFT traders. And if you're actually buying a position for a long hold period, this is actually a benefit to you because your order gets filled pretty quickly. If you're actively trading, it's a bad thing for you. But most retail people are not trading hundreds of times a day, so it's actually not an issue. And if you look in cryptocurrency and you think about, okay, well, what sort of brokerage models will work here? If it's a space where anyone can, sitting in their garage, build a UI on top of this on-chain order book, then charging $10 to place an order E-Trade style is not going to work. But if you build a really nice experience that's super smooth and fast, and you happen to be selling the flow to HFT people, users are probably going to be fine with that. They might not. The world may tend more and more towards privacy, but I think people only tend towards privacy when they're forced to for some reason, like something got banned, as opposed to actual concern for privacy. So I think the Robinhood model will work pretty well in crypto.
All right, so let's dive into Auger, Joey. And I know you're passionate, obviously, about Auger. I wrote a blog post a few weeks ago about kind of the idea of Auger codes, or people build 0x relayers basically for the Auger protocol. I'm generally of the opinion that we will kind of see Auger codes make Auger much more accessible and usable, and that they'll kind of capture value. It's unclear to me if they'll ever fork Auger itself, but they may choose to. As you kind of think about that, Joey, I know you disagree, but what in a world where I control 15% of all Auger, right, and I got $1 billion of volume, what's my incentive to stay on Auger? Why not fork off as a selfish Auger co?
Yeah, so I think if you look at Auger as an example, the network exists to secure the assets on the network. That's the sole reason that the protocol exists. And if you look at the concept of forking it, the way Auger is designed is it's designed to operate at the marginal cost of security. So if Auger is never designed to charge extra fees than would be necessary to keep everything incentive compatible. So if you want to fork Auger or copy it, and you want to make things cheaper for the user, you're going to have to compromise on security. And so the problems with that are that it can be in people's financial incentive to steal the money. That's one problem. Or the other problem is you just ditch the existing system and kind of make it more centralized, where it's maybe M of n multisig that resolves everything. And I think the second part is a fair argument. That's kind of basically just saying well, this decentralization thing could kind of fail and people will just return back to centralization. But I don't think we'll see a world where somebody forks Auger and makes a decentralized version of Auger that's also a fork, because there's no economic incentive to do it.
And just our kind of discussions about that post, Dennis had some interesting ideas around re-centralization.
Yeah.
Do you want to unpack?
Yeah, so I tend to agree with Joey on this. So I think that, in the extreme case of a relayer or an Auger company forking the protocol is that they literally just fork the Auger oracle out entirely and become a completely centralized prediction market. And so Gnosis is another prediction market protocol, and they actually have the oracle as a modular piece where you can assign a centralized oracle. So that is a viable approach, and there are companies who've tried to do this. But then I think you have to zoom out and ask the question, why haven't we seen any centralized prediction markets at scale? And I think the problems come back to regulation and the sort of perils of being a traditional company operating in that vertical. And so the meta question here is why do we need a decentralized oracle in the first place? And as Joey said, if the trade-off when you fork a decentralized oracle is that you have to trade off cost for security, that may not be a trade-off that you want to make if the whole reason that you're using Auger in the first place is that it is the most secure, the most decentralized. And so I think to bring up back this example of libraries versus networks, like in 0x, you do have relayers forking the protocol and forking the contracts because there's no liquidity, there's no network effects at the protocol layer. But in Auger, as Joey mentioned, you do have both network effects and pooled liquidity in these canonical smart contracts. And so I think it makes sense for companies to build on top of that rather than fork and trade off the security, because then you go back towards the extreme of centralization.
One theory, kind of building on that, we've kind of discussed internally is the idea that, and you guys have alluded to this, is like, what if you just re-centralize it? And of course, the problem is like, well, existing regulations. One thing I've always kind of thought about is like, we kind of saw this happen last year with ICOs, where like, I would argue the biggest takeaway of ICOs in 2017 was, let's assume they were all unregistered security offerings, and literally everyone broke the law. Even if you take that most extreme view, we can also say like the vast majority of the capital raised that way seems to have been raised by, for the most part, honest actors with good intentions who are doing what they said they did. There may be a lot of scams and like maybe they get the headlines, but the absolute dollar numbers raised by the truly below the bar projects is actually quite small on a relative basis, and on an absolute basis too, it's not very large. And so kind of tying this back to this discussion, I've always had the hypothesis that through decentralization, we can circumvent kind of regulations through these open protocols. The world will see that, hey, wait a second, assassination markets don't pop up on Auger, right? Like, it's okay if people bet on politics. It's okay if people bet on football without like going through the state gambling license, right? And the world will be totally fine, and then the laws will just like evolve to accommodate that. That's kind of been my naive, not naive, but just like one.
Yeah, and then I think in addition to that, like we'll also see like tons of use cases that are hard to imagine in a traditional, a centralized prediction market. Like we've already seen like a bunch of bug bounty markets created on Auger, where it was like, the question for the market was, will the developers of this project fix this bug, yes or no? And so if you vote no, it's a bounty for the developers to go and actually fix it. And I think like, this may seem like a weird niche use case, but it's hard to imagine something like that popping up on a traditional centralized marketplace and having people trust it in the same way that they trust Auger. And so I think like the question is, how big is the market for for decentralized prediction outcomes? Like, how important is it that it's decentralized? And I think the first thing that pops to mind is obviously all the things that you can't do in a regulated environment, you'll do there, and that's probably small and niche, but there's also probably a ton of new use cases that are hard to imagine today that just wouldn't pop up on existing infrastructure. Just like smart contract platforms probably will have different applications that you wouldn't deploy on AWS, for example.
Yeah, I think there's like two other things I would add is, I think if you look at a platform like Auger, it's kind of trying to be like the long tail of new financial contracts. So if there's something you want to speculate on and you can't do it somewhere else, Auger could be a place to do that. And so it's kind of like almost like eBay or Amazon in the early days, where it has this long tail of other things, and then eventually it starts building its way to going over things that you do in other markets as well. And the other thing I would say is on the topic of like aggregation theory and people building UIs on top of stuff. This doesn't just apply to Auger, it applies generally, I think. I do think it will be possible to have user interfaces to decentralized applications that are actually peer-to-peer, that are as good as Web 2.0 apps today. That feels very hard to see right now because the experience for using all of this stuff is really bad. But there's a lot of technical improvements on the horizon that actually aren't that far off, like 6 to 12 months, where I think we'll start to see experiences where you can access entirely decentralized applications like Auger, but directly in the browser, where the thing is hosted peer-to-peer using BitTorrent, and you don't have to trust any one person. And you can log in with a username and password, and like you have all these sorts of things that you have in regular apps. The one kind of big area that's still hard to abstract away is the fact that you're using cryptocurrency and blockchain tech, because you have addresses and things like that are super weird. But I think even as things like ENS start to appear, you can send an address to, Kyle, or send an address to Jesse.Walden, as opposed to, 1B327, et cetera, et cetera, et cetera.
Is kind of thinking we've got like a couple minutes left for our dialogue before we'll open it up for Q&A. As you guys generally think about the space and these kind of discussion topics, are there any generalizations you guys take away? You've alluded, Jesse, to libraries versus state, and any others where value will capture?
So I think that one is like one of the biggest for us is this a true network with network effects? And usually that maps to there being some stateful contract underlying the network, or is it a library? And that's an analysis that we've done and it's worked really well. And then the other is sort of the meta question is like, does this, will this token capture value either by virtue of like, capturing revenues in the network or by virtue of becoming sort of internet money? That's another sort of general framework that I'm sure you guys have talked a lot about today already.
The network versus library thing is really interesting. I hadn't heard anybody put it that way before. When I think about it, I just think, I ask the question, why shouldn't it, say I'm building on top of this thing, why shouldn't I just copy it? And there should be a good answer for that. One answer is, well, if you copy it, it'll cease to be secure, and there's a decent chance that everyone's money will get stolen. Or the answer could be, well, if you copy it, your copy version will basically be centralized, so why don't you just start a regular business? Or the answer could be a bunch of other things that none of us on this panel have even thought of, but there needs to be a good answer there, I think.
Yeah, we found that we haven't, I think the framework Jesse presented with libraries versus networks is a very good one. We haven't found too many others with regards to like how far up the stack or down the stack do you go. So for example, while I think Auger codes or centralized prediction markets can probably capture value, I also think that the underlying cryptocurrencies, whether it's Ethereum or EOS or Definity or Algorand, I think those also are likely to capture a lot of value in a very different way. I think those as being kind of like internet money. But in general, my sense is like at the lowest levels, we probably capture value at the base protocols. I think aggregation theory can apply to some degree. We'll capture value at the consumer levels. The stuff in the middle is a lot more questionable. We have made investments there in things like LivePeer and Starkware, but ultimately in the long run, where value gets captured is still pretty TBD. And yeah, the generalizations are I think not quite there. Cool. And with that, we can get into questions from the audience.
So question from Dan around governance and value. So as it relates to governance in ZRX, is it fair to consider the maximum value of governance in the network to be equivalent to the cost of forking that network, which is inclusive of all the lost future revenue, OpEx, CapEx, et cetera, sort of discounted back to today?
So I have a hard time mapping the value of governance in 0x to the value of what's happening in various relayers, because again, I think there's sort of a disconnect between those two things. So the question is, what in 0x, what exactly is being governed? Is it the format of the messages for orders, or because and if so, like, does that have any value, or is the value further up the stack in the liquidity pool that's controlled by a centralized relayer? And if it's the latter, then it's hard to see how the 0x token has any enforceability over how that centralized entity governs itself. So I don't think there's an easy way to map the value of governance in 0x to what's actually happening in 0x relayers, unless they somehow change the protocol and find a way to incentivize relayers to pool liquidity at the base layer, in which case 0x would be the token would be enforcing governance over the smart contracts. So it's directly enforceable, and then it maps a little bit better for me.
To that end, I know maybe it was probably early this year, someone wrote a blog post basically trying to value governance in 0x, and they basically walked through a hypothetical kind of case study of the cost of forking, and they had like, made up some assumptions of relayer has 10% of the market and total volume going through the system is $1 billion. Right, like they made up the hypothetical for how much revenue they would lose by no longer being part of the liquidity pool, which that was, I think, a wrong assumption, but like they kind of assumed how much revenue you lose by forking off and kind of not being part of the liquidity pool. And they ran all the math on like how a rational market actor should value 0x tokens and how much they should be willing to pay. And the funny thing about the analysis was that I think the relayer in this example, like hypothetically, was generating $10 million of revenue, but the value of the 0x they needed to purchase to justify like that was like 50 or 75 million, and so it was like five years worth of revenue, which like that ratio, like again, didn't fundamentally make sense to me. So I think it's a pretty tough challenge. But if you Google like 0x forking, cost of forking, leaving, like that post will come up somewhere. I think we got a question over here.
So we're talking a lot about tying together these disparate pools of liquidity, aggregating them rather. But I think we're avoiding the question of, how do you attract liquidity to each disparate pool in the first place, right? How do you attract the institutions that are currently providing liquidity on centralized counterparts and see a lesser order matching engine when it comes to connectivity and sort of encumbering their assets? So what hurdles do DEXs need to overcome in order to attract that institutional flow and liquidity?
I'd say this, so the simplest thing to do is to allow trading of assets that don't trade anywhere else. And this may sound silly, but it's really important. And the reason is, if you're an institutional trader and you're trading something that exists in the regular world, things are really efficient there. Markets are really fast. Things happen in microseconds. And then if you look on the DEXs, things happen in seconds. Things are slow. Things are expensive. But if you're trading assets that don't exist anywhere else, you have a benefit, which is everyone else is on the same playing field as you. So high-frequency trading is just about being faster than the next best person. And HFT has existed for hundreds of years. When Napoleon lost, somebody flew a carrier pigeon and then traded off the news. And so I think the long story short, you have to make it so that people can trade things that they can't trade other places. Then you have a level playing field where you're not just getting killed relative to the regular market. Other sorts of user acquisition apply as well. So the sorts of things that attract liquidity to other providers apply here. I think we'll see a lot more liquidity provisioning on things that are more like betting as opposed to financials in the beginning, because betting has high fees and it's much easier to acquire retail users. Versus if you're trading straight up financials, then you have to go after institutions. And for institutions, before you can even think about getting them onboarded and adding any liquidity, they have to check a bunch of boxes on the compliance side. And the tech's not there yet. People are starting to build layers on top that have KYC and AML for people who are trading on DEXs. But that's probably months away. And then you have all the educational process for the institution and all the sorts of regular problems you face. So I think it's kind of a mixed bag of things. But I think if you start in areas where the markets don't exist today in the regular world, that's the best place to start.
So all the classic examples of aggregators, Netflix, Google, Facebook, Amazon, these are all the front ends, right? These are the things that the consumer is actually clicking on. Is crypto the first example of an aggregator that's really the back end? Because, and the example I'd give you is the one that you gave earlier of Coinbase and Bitcoin. If Coinbase went and forked Bitcoin to make their own version of Bitcoin with whatever parameter change, like people don't want that. Even though Coinbase owns the front end and it's the place where I'm clicking, like the customer relationship isn't really owned by Coinbase, it's owned by Bitcoin in that example. Are there any other interesting examples that we can learn from of backends that have actually owned the customer relationship?
It's a great way of framing it. I think it speaks to this idea that the smart contract itself is the sort of is the canonical sort of focal point of the network. As far as other examples, I don't know. That's a great question and something I'd like to look into further. But I think it's true that if the big innovation of smart contract platforms is trustless computation, and that sort of moves up the stack to applications that you don't have to trust. And so if you start to trade off security or trust for cost because the application layer is making that decision on behalf of its users, you start to the whole nature of the application and why users are using it in the first place, I think, gets thrown into question. And so I think that speaks to the point that, yeah, this is the first time where users are using this because the backend is trustless and the backend is this aggregator that has a network effect that as more people join it, it becomes more secure, more trustless.
I think the way to just think about that specifically is just that, in this case, the bottom of the stack, Bitcoin in your example, is just, it's internet money, right? And maybe we have 50 internet monies, maybe we have 3 internet monies. I'm of the opinion it's likely to be closer to 3 than 50 on a long enough time scale. But I just suspect the fact that it's internet money is what it's valuable. I mean, US dollars are valuable, but today, we have cash, but most money today is electronic, right? We see Visa and Venmo and PayPal. But the dollars are still, obviously, there's $10 trillion or whatever the number is. I
mean, one example I think that's kind of hand-wavy, but doesn't quite one-to-one map, but if you look at, like soft drinks, so like Coca-Cola or Pepsi, they're not actually directly interfacing with the customer at the front end. That's the restaurant, that's the store you go to, that's Amazon.com. But they still have a network effect because you want to drink Coke or you want to drink Pepsi. You don't want to drink like whatever the generic thing is that they serve at some fancy restaurant in San Francisco. And so that's kind of like one area where I think it's kind of close. It's definitely not a one-to-one relationship, but it's the closest thing I could think of in 30 seconds.
I think we have time for one more question. Anything else out there? If not, alrighty. Well, Jesse, Joey, thank you guys for being here.
Thanks.
Love this discussion.